Ladies and gentlemen, good afternoon, good evening. This is BIA Kelsey Live, and of course, that's our canned audience here and canned weather introducing the show this week. I am Mitch Ratcliffe. I'm a senior analyst with BIA Kelsey, and I'm joined by Mike Boland, also an analyst with BIA Kelsey and our editor-in-chief. How you doing today, Mike?
I'm well. How are you?
It's a little cold here in the Seattle area, about 28 degrees right now, but it's sunny, so we have a little of the best of both.
Nice.
So this week we're going to talk about a bunch of interesting news. We are analysts. We cover local marketing and media, and I want to talk about three stories this week. Facebook's earnings. Starbucks has an interesting new voice-driven barista app that will automate ordering. And finally, we did some research and following on our several years of coverage of the local on-demand economy, have projections for how much was spent in 2016 as well as what we expect to be spent in 2017. So let's start off at the top of the list. Facebook had a blowout quarter from a lot of people's perspectives, but there might be some weakness in there. First off, they reported yesterday a Wall Street beat. They had been expected to bring in about $1.34 a share, but after adjustments, it was $1.41. So that would be a beat of the projected results. But their net income was actually $1.21 per share. So they didn't not beat, but they had to do that based on adjusted one-time gains. And so good quarter. They had revenue of $8,081,000,000 during the quarter, the fourth quarter, and that was up from $5.8 billion a year before. So we're talking about an increase here in revenue of almost 50%. Daily active users on the platform were 1.23 billion. That is for desktop, an 18% year-over-year increase. Mobile users were 1.15 billion, 23% higher than the year before in December. And the total active users across both desktop and the mobile were 1.86 billion. So they're approaching 2 billion active users during a month. How was the quarter, Mike, and what do you think we need to be paying attention to?
Yeah, a lot here to unpack. So the top line, 8.8 million in quarterly revenue, or billion, excuse me, was up 51% year over year. So that's clearly strong revenue growth, and we believe that's mostly a result of the election advertising it saw in its fiscal Q4 quarter, as the election really wound up. It's also seeing growth from Instagram, which now represents about 10% of its ad revenue. But some other notable stats are what you mentioned. So monthly active users are 1.86 billion. And mobile, among those active users, is 1.74 billion, which is 94% of the total. So that signals that Facebook has, clearly made its transition to mobile successful. But I think even more notable is that among those monthly active users, if you look at the daily active users, so among the 1.86, 1.23 were daily active users, which is 66%. Right. Now, this is an important metric that not a lot of people pay attention to in these kind of earnings analysis, but it's a stickiness metric, essentially.
Exactly.
And I think this is important because it dispels the myth and the now famous article in The Information from about 6 months ago that Facebook is losing stickiness and that kind of day-to-day repeat usage to things like Snapchat. So I think that's very important that Facebook is proving that that's actually wrong. And that's really evident in these numbers. And then another thing that stuck out to me is that mobile ad revenue represents approximately 84% of the ad revenue for Q4. Right. But interestingly, so that's a lot, but that's the same as last quarter, which signals to me that it's actually kind of plateauing because it was ramping up. I mean, a few years ago, it was like 50, and it's been ramping up. And we've been watching that closely in our forecasting, and we were kind of wondering when it was going to kind of hit that ceiling, at least from a share of revenue perspective. And in our forecast, we actually have that plateauing right around mid 2017 and going into 2018. So these earnings kind of validate our outlook that we're starting to plateau at that, 85% of ad revenue that's mobile.
Well, and that's interesting because anytime you get into those numbers, you just start running into diminishing returns.
Yeah, it's always gonna happen.
But what
Yep.
I saw in this was that Facebook is getting a lot more out of their current investment as well. So they do seem to be improving their overall productivity and efficiency in terms of the investment and what they get back because of the stickiness. It also shows that the older folks, the people who are using it more and more, are offsetting some of the failure that Facebook is reportedly having in winning youth
Yeah.
away from Snapchat in particular. So I see a lot of strength here. But I also see a company, as you're talking about, that is probably in transition from rapid growth to, in this case, not settling out, because we know channels are going to proliferate, but
Yeah.
we have to question where Facebook's ability to extend its channels
Well,
lies.
the channels is important, and this is an ongoing theme that's evident in these numbers, and it first came up in the last quarterly earnings, which is that, and this goes back to why the mobile ad share of revenue is plateauing, is that they're reaching maximum ad load in
Right.
mobile. So that means they're going to have to look elsewhere for that ad inventory, and that means Instagram, which they've actually already started to do with Instagram stories. It really, we talked about that a few
Right.
weeks ago, which represents a lot of good potential for monetization in mobile. It means Facebook Messenger. It means their audience network, which is their third-party affiliate publisher network of sites through which they
Right.
place ads and monetize. It's kind of like
Including Instagram, too.
yeah, including Instagram. It includes WhatsApp and potentially other acquisitions to come. So I actually predict that we're going to see more acquisitions that will
I agree.
unlock user engagement and thus ad inventory, because this is going to be a big deal for Facebook and thus an area of investment where they're going to pay a lot of attention to. But I think meanwhile things like Instagram stories show promise for kind of ad models, and we'll see that, I think, develop in the next few quarters as well.
Well, so that's interesting. So maybe what we're seeing is the dawn of a consolidation era
Yeah,
and a lot of buying. Certainly. I mean, look at how much money Apple has in the bank now. Is
yeah, a lot of
$246
cash.
billion
Hmm.
as of the end of the quarter. I do believe you're going to be seeing a good deal of acquisition activity as VC activity sort of peaks.
Yeah.
It's going to be both the combination of uncertainty about the direction the economy is going, but also because the private equity people have moved in so aggressively into that space. Private equity people like faster transactions,
Of
and
course.
that will point towards consolidation.
Hmm.
So really going to be an interesting time. And I think Facebook's numbers here, while are spectacular in the way that when a firework reaches the peak of its arc, it starts to look really beautiful. But it's going to disappear in a moment.
Yeah, and Wall Street knows that. I mean,
Yeah.
despite what the way you described it at the beginning of, I think, a blowout quarter, and I
Mhm.
agree with the numbers indicate that the actual, the kind of how the public markets reacted was not
Eh, eh.
that. It was just kind of
Yeah.
like I mean, in after hours trading, it did go up a little bit, but
Yeah.
not correlative to the kind of the earnings. And I think it's
Yeah.
some of those uncertainties that Wall Street's detecting, and that's why the share price isn't really reflective of the kind of performance, at least what we saw
Well,
in
and
the last
also,
24 hours.
yeah, well, also I think that's a reflection of the fact that it was a lot of political revenue,
Yeah,
and they can't
that's true.
expect that for a couple of years too.
Yep.
So let's move on to the next one. You identified this one as the one you wanted to talk about. Tell us about Starbucks My Barista.
Yeah, so this is something that Starbucks has come out with that I think represents the continued growth of voice search. And as background, so Starbucks is what they're doing here is being an early adopter to push this technology, which I appreciate, and it's within character for Starbucks because they've been the single biggest catalyst, I believe, in market educator when it comes to mobile payments.
Yes.
And also the order ahead functionality, which I've always said is actually going to be the thing that gets people to use mobile payments because it has this tangible value exchange in that it saves people time. So it gets people over that adoption hump of mobile payments, whereas all other mobile payments providers are saying, use this because it's a shiny new thing, and they're just falling flat. No one wants to
Right.
change the way they pay for things unless it's something that's a tangible value exchange. So that's the background. And part of that is their order and pay functionality. So what we're now seeing in the kind of most recent development in today's news item is they're adding voice search to that. So it was more of a kind of tap and texting type of interface, they've now added voice search so you can essentially speak your coffee order as opposed to tap it in.
Right.
And I think that, that's cool. And I like that they're doing this. Again, they're being kind of an early adopter and pushing the technology. The actual integration, I'm a little bit skeptical of from a devil's advocate position. And we talked about this last week in some applications of voice search. We're early days, everyone's experimenting. Some of the actual use cases are not as conducive to a voice query. I think a coffee order could be, but the problem is that I think we're too early in the speech processing and the AI for a very delicate and precise string of words where accuracy is critical, such as a coffee order. And there's going to be
mine's
several...
obscure. It's difficult to explain.
And there are going to be several like kind of damn you autocorrect moments and screwed up orders in a spoken query sense. And I think, I guess my point is that downside or that potential downside of the complexity of the terms and the iffiness of the AI and the speech processing doesn't outweigh the upside, which I believe is a marginally incremental benefit of speaking rather than tapping your order. I think it's, for most people, it's not as compelling of a value proposition. So I think it's very cool. It's something that they're experimenting with. I like that they're doing. I don't mean to downplay it, but I'm skeptical that it's going to be like adopted in mass. Now, one response to that could be that the Starbucks consumer base tends to be a little bit more tech savvy and early adopter.
Sure.
So they do have that.
And there are 13 million people who use the Starbucks rewards cards.
Yep.
Most of them on their phones.
Yep. Mm-hmm. So not sure where that'll go, but I have some skepticism, so I'll just...
But, so there was some information in their quarterly report late last week about the fact that they're really retooling the in-store experience to start to support the people who are ordering ahead.
Yeah.
And they had a lot of dissatisfaction with the early order ahead experience because people would show up and either the drink wouldn't be ready or it had been ready, way before they had thought it was going to.
Yeah.
And Howard Schultz specifically addressed the fact that they need to begin to perfect this. And having watched these guys for years, I happened to go to one of their flagship stores where they do a lot of testing. They're retooling the in-store experience for people who are passing through much more quickly. And I think that's going to be an important part of the other end of that customer experience. So if you get past the damn you error correction thing, you are still potentially going to have a cold drink today. And I think by the time that this is fully rolled out and that they have done that work in the stores, they'll have a much better mobile experience than anybody else, simply because they took it early and they took the operational challenge seriously as well as simply the software.
Well, yeah, and when they get there, I think that, when the system's humming along and a lot of people are using it, I think their yield optimization is going to benefit because it'll just be like a quicker process of orders getting through the system. As opposed to so you're taking out the human error and talking to the how's your day, like all of that. I mean, and just overall those kind of like efficiencies of just having like an electronic order getting through the system quickly gets more kind of revenue per day and those types of metrics for Starbucks. It'll take a while to get there because, as you point out, the actual systems in place and the logistics of it have to be ironed out. But also, when you have the majority of consumers still doing it the old-fashioned way, the two systems probably don't meld well. When a certain percentage of people are ordering electronically, that's when there'll be that tipping point and they can start to really see the system hum.
Yeah.
But another interesting thing about the when you said cold coffee or it's sitting there too long, it made me think another part of this announcement is that not only is it a spoken query through the app, but they've also developed an Alexa skill so that you can do basically the same thing, but through Alexa. And I was also a little bit skeptical there because I think that use case is limited to people that live like within 5 minutes of a Starbucks because the order is happening at home.
Unless you expect Alexa to end up in a car.
Or maybe there's a car Alexa. That's true. Yeah. But I think in most rural areas, people don't live within 5 minutes of a Starbucks, and that's a guess. I'm not sure, but I don't know. I think there too, it's a very good idea. I love that they're experimenting, but in like the day-to-day on-the-ground realities, they might run into some issues.
Maybe
that's the point.
Demographics is a real monster. You got to fight it, and you're right about the rural experience. I live 2 minutes from a Starbucks, so, but I
live 2 minutes from 8 Starbucks.
There you go. Well, actually, I live 2 and 4 minutes from Starbucks, but
Yeah.
and 7 if I go a different direction. But uh, it's interesting to see a retailer thinking about how to roll the technology experience into the human customer experience in the store. I also saw this week the introduction of a barista robot, not at Starbucks, which was essentially an industrial robot that picked up cups.
Hmm.
That may be something that you would see in the back office or the back of a Starbucks in the future, making all these orders. But I still think that they understand the value of some of that how's your day stuff when people want to be personal.
Yeah.
And coming up with the right mix of that and setting the expectation with the customers that they can either have a very friendly, intimate experience or one that is just fast and efficient is an important issue for a brand like Starbucks.
Yeah, and I think some of the skepticism I mentioned, I bet they're fully aware of that, and their whole point is let's work out the kinks by doing this in kind of a
Yeah.
limited rollout, because I think that's exactly what it is. I think it's available to like roughly 1,000 customers nationwide, and however many stores that is in their beta test. And I love that they're doing that. It's really
Yeah.
it's the Google method of like getting stuff out there, getting it beta tested, and
And feedback.
experimenting, and doing so with like they have the balls to do it despite some of the skepticism that I mentioned and the logistical problems we probably haven't talked about. And, so my skepticism isn't meant to downplay what they're doing because I actually think it's very cool.
Mhm.
But they'll run into some growing pains, which I'm sure they're aware of.
And the smart businesses go ahead knowing that.
Yeah, fail fast.
Businesses that try to avoid failure are going to fail.
Yeah.
So let's move on to the last topic for today, and that's the local on-demand projections. And both you and I have been covering this for several years. I developed a model about the beginning of 2015 to understand how much revenue these marketplaces actually transact and how much they're paying to employees and how much they're retaining for of their own revenue. So let's put a little context around the story first off. We've tracked more than $16 billion in venture investment that has gone primarily into U.S. on-demand companies over the past 8 to 9 years. And Grab a Gardener is the most recent one. They raised an undisclosed Series A round on Tuesday. But that most of that money has gone, frankly, into Uber and Lyft. Uber has raised about $10 billion in venture capital and another $3.8 billion in private equity and debt. And as a result, we're talking about an industry in which one company represents 3/4 of the total investment so far. Now, that means that there are several clear leaders that we can look at. Uber and Lyft are obviously two of them, and the other one that is an interesting and large player is HomeAdvisor, which is a division of IAC. That's the company that owns Match.com and a number of other assets owned by Barry Diller as well, or run by Barry Diller. And so we looked at where we believe last year's spending worked out, and in 2015, we estimated the total spending had been $22 billion, which was a little higher than we had originally projected at the beginning of the year. We'd expected it to be about $18.5 billion. By 2016, we believe that the market reached a total revenue or transaction value of $34 billion in the United States, out of an addressable market of $660 billion. That is, where the services were easily accessible by a sufficient number of people for them to be relevant and found. But that $34 billion represents 5.1% of the addressable market. It took years for e-commerce to get to the same level. So what we're seeing is something that's going a lot faster in terms of adoption. But it's important to understand that $34 billion doesn't mean $34 billion in revenue to Uber and Lyft and HomeAdvisor and the other
transaction value, right?
1,600 companies that we've got. It's transaction value, out of which they're taking between 33% and 20% of the revenue as service fees from the drivers, essentially, that they pass those monies on to. So it's important to understand the difference. Uber and Lyft and HomeAdvisor have only extracted about 20 to 30% of that revenue from their transactions. So we estimate that was, at Uber, about $5.5 billion in transaction revenue, or in revenue. So they actually booked roughly $21.1 billion in revenue. Lyft, $700 million, so they did about $2.4 billion in actual transaction value. And HomeAdvisor, where we actually have this kind of data, we know produced about $505 million in transaction revenue, or in total revenue out of their transaction share. So that would be about a $2.2 to $2.3 billion transaction value. So lots is going on. Only HomeAdvisor made any money amongst those companies last year.
Yeah.
They enjoy certain benefits being part of a distributed, integrated company that others don't. So they're benefiting from referrals across the different IAC businesses. But they only made about $50 million in profit last year based on what they were doing. Now, where are we going in 2017 is the big question.
Yeah.
Today it's 5.1%. We see very rapid adoption, both by companies of on-demand services, and that's rolling in on-demand in a variety of different contexts: restaurant delivery, service delivery, product delivery, and so forth. So what we expect to see happen is in 2017, we have an addressable market of $785 billion. That's part of our model. It's based on normal adoption. It's accelerating faster than we expected. So we've raised our 2017 total addressable market estimate to $785 billion. And we believe out of that, about 7.3% will be actually realized transaction revenue by these brands.
Yeah.
So that would be about a $57 billion industry next year, or rather this year. It's going to be a surprising amount of growth. And I think what we might see in the early part of the year is a sort of a pause or interregnum because of the many different concerns around the structure of the employment relationship. But as these revenues continue to grow for these early leaders, I believe that's going to spur yet another round of investment.
Yeah.
So where are you seeing this go?
So I think it's interesting. The share of revenue, so taking the transaction value, the share of that they're seeing in revenue, I think it makes sense that that's going to grow because in early days, this model is all about blitzing user growth and
right.
Basically that network effect in a two-sided marketplace. And Uber is a good example of that. And that's the reason for the magnitude of capital investment you pointed out. It's really about just getting enough assets and marketing and all that stuff just to kind of blitz user growth, probably
right.
taking a lower share than the eventual business model will call for, and that's why we see them losing money. Now, as they mature, I think the name of the game is going to be monetizing in a more substantial way. So you're going to start to see the percentage of that transaction value that is realized revenue for these players grow to meet the figures that you mentioned. I think the other thing you're going to see is and we've been saying this for a while and seeing it grow, but we're going to see it continue, is that, like, the API integrations and deep linking to get these on-demand services embedded into more kind of complementary apps and functions. That's another thing that I think is going to start to happen more.
Well, and that would require, for instance, going back to the Alexa example, Alexa, get me my favorite sandwich has a whole series of lookups of what is your favorite sandwich, how to reach the organization, order it, and get it there. A lot of steps, logistical steps to continue to work out. But yes, absolutely, when it is that natural, it'll be very easy for on-demand to be a natural component of just daily life. I actually see the share of revenue that they're going to be taking out declining. So what will happen is over the course of the next 10 years, let's say, we'll go from the current 20 to 30% to somewhere more like a credit card share of revenue. I'd say it's somewhere in the 5 to 7% range. But what also happens once you get large pools of people working in this environment is you have secondary revenue opportunities, because you can organize and create buying clubs, you can provide insurance, you can provide financial services, and we see hints of this, but Uber and Lyft partner to do those things. I think in the long run, these marketplaces become banks themselves, but because they're focused on the transaction success, they'll be offering different services that actually add up to much more revenue overall, while lowering their share of the take from the worker.
Yeah. Well, I mean, the additional revenues is going to have to come from somewhere because right now they're
Right.
losing money, and that's partly because they're still in that early period of
Hmm.
capital intensive growth. So I think
Right.
that as they mature, the costs will come down. So that will mean better margin, but also they're going to have to reconcile in some way if they are reducing their share of the transaction. They're going to have to reconcile that somehow with, I guess, additional services, as you point out.
Hmm.
Because yeah, I mean, everyone knows right now they're losing money. So I mean, where is the profit going to come from? I guess is the question.
Yeah, oh, it's interesting. Another news item today was that Uber is doing a deal with Daimler.
Oh,
They previously agreed to buy $10 billion worth of autonomous cars from them.
that's where
But
it's going to
what?
come from. Their costs are going to go back down because there's no driver cost.
Well, the problem is the drivers also eat the capital costs right now. So I
Sure.
think that's an equal offset. But
Yeah.
what they agreed with Daimler to do today was to essentially white label a service for Daimler for autonomous cars.
Okay.
So that means Uber is starting to fade into the background
Oh,
and become an enabler of these sharing models for
there
the
you go. I
industry.
mean, it gets into services at that point. That's
Right.
interesting. If it becomes the go-to kind of logistical provider for some of these other players who would much rather have Uber do it than build their own, which is
Right.
probably hopeless. And I think probably Uber sees the trend line towards an autonomous vehicle future and the fact that Daimler and not only manufacturers but all kinds of entities are going to be launching these types of things and they can sit in the background. Maybe
Right.
that's where some of that incremental revenue comes from. That's
Yeah,
interesting.
I think that today's announcement actually is one of the more significant things Uber's done in a while.
Yeah, yeah,
And I think the other one is that eventually, once this logistics system's in place, we have to allow the people providing the service to start to differentiate, and that means not a commodity pricing model, but a pricing model based on relationships. And
sure.
you know, and the relationships are not somebody picks me up and takes me to the airport, but if I want my kids taken to school every day, I don't want just any old driver to do it. I
Yeah,
want the same person to do it. I did a poll of an audience I was speaking to on Monday in Bellevue at the Chamber of Commerce in Washington, um, and no one would put their kids in a car with a stranger or have a stranger come into their home to clean, but they all agreed that if they had an ongoing relationship with somebody, that
yeah.
they would. And so that's a stark trust problem that we have yet to work out, and I think that happens when we allow prices to float based on the quality of engagement.
Yeah, there's a company called Shuttle that was in the Bay
Hmm.
Area. It was a Comcast Ventures backed company
Right.
that has since gone out of business, and they were going for that exact model of it's basically Uber for your kids, and they were
Hmm.
basically lots of minivans. Obviously, a very kind of high security bar they had to reach. I think it was only women drivers actually allowed on the system. I could be wrong about that, but there were a number of kind
Hmm.
of factors like that in place. I actually don't know the reason for their demise, but it was an interesting model, and it's really all about building trust, as you point out.
Right. Well, I think the reason that Shuttle went under was that there wasn't sufficient differentiation in the marketplace at that time to make it clear that the ongoing relationship to protect your kids was the value.
Yeah.
It was cast against the falling price of mobility on
Oh,
demand,
yeah.
and I think that was a failure of their brand development.
Yeah. Interesting.
So, so it's going to be a big year next year. $785 billion in addressable market, we believe, for on demand. That's just in the household and driving services categories, not in the business service categories. And that means that we could see $57 billion in transaction revenue this year.
Well,
Going to be an important year for on demand. So that wraps up the news for this week. Mike, what are you working on? Any new reports coming out?
a lot of stuff cooking right now. I'm kind of in a lull with respect to being in between reports, and I have a number of different kind of events I'm focused on. I'm speaking next week at Contact.io to
Hmm.
talk about the takeaways from our mobile call monetization, call commerce paper, and that should be an interesting show. And working on a few other things such as webinars and things. But you ask a good question. I think we're going to be public soon with what our kind of upcoming editorial is going to be. But the hints are all over these podcasts about the kind of the
Our
topics.
direction. Yep.
Yeah, our direction and the topics that are going to be most impactful. The things we're looking at are mostly going to represent where we kind of place our chips when it comes to editorial treatment, especially long
Right.
form, analytic kind of editorial treatment.
Well, yeah, I'll be speaking next week. In fact, we won't be able to record it this time because I'll be on stage at the Power Chord Summit in St. Petersburg, Florida. If you're in the area, please touch base while I'm there. And I'm working on several vertical industry reports, automotive and healthcare, to start with for the beginning of the year. We also sent out a poll about what kinds of topics people would like to see us cover. And if you'd like to receive that, please send an email to me, and I'd be happy to send you a version of it so that we can get your feedback. mratcliffe@biakelsey.com is my email address. And with that, why don't we say goodbye? Goodbye, Mike.
Thanks.
Thanks, everybody, for listening. This is BIA Kelsey Live. We'll see you not next Thursday at 10 a.m., but another time, which we will make available as an archive so that everybody can keep up with the show. Take care, folks. Have a great weekend.